So let's begin, and we're going to do a quick update of the models. I think the important thing with these models is that people understand what they're for. They're not a magic lamp that you rub and a guy comes out and hands you a bag of money. They're certainly not that. What they are meant to do is participate in the markets with the same or less risk than the S&P 500. So your drawdowns are smaller, your beta is smaller, your standard deviation is less, and still be able to show some good results. So here is, let's begin with CPM from the beginning of the year. CPM Plus, by the way, is the newly, what would I say, revamped. CPM is now 6 indicators. It used to be 3. It's much more robust. We've changed some of the indicators around, and we have much better performance. So here's from 2023. You can see this is just this year. CPM Plus is in green. The S&P 500 is in blue. So you can see we're underperforming by about 0.8% for the year. But again, we're doing that. I don't have the slides with you, but you can but you can go to the website, go to asburyresearch.com and go to models, and you can see that this was achieved with half the beta, half the drawdown as the S&P 500, much less standard deviation, much better Sharpe ratio. If you don't understand any of these terms, you can go to investopedia.com, or you can contact us and we'll send them to you. But basically staying right with the S&P 500, stuck like glue to it, but with a lot less risk. So now let's go back to CPM Plus and look at historically, because that is what matters. We're not day traders here, so we're much more interested in how it's done historically. So now you can see this goes back to 2017. So we've got 5 years here with CPM, and what this is showing, I'm just moving a couple of windows out of the way here so I can see my own chart better. You can see that CPM has, again, stuck with the S&P 500 like glue since 2017, and currently during that period, it's outperforming the S&P by about 10%, 64.8, 65 versus 75.6. So anytime that you could stay close to the S&P 500 with half the risk, it's a big deal to me. That's really a hard thing to do, because there's a very much a push me, pull you with the more you, if somebody comes and tells you, we beat the S&P by 30%, how much did they risk? Let's see what their drawdowns look like after 5 or 10 years. So this is a way for older, more risk-averse investors to be able to play the game with similar results with less risk.